now is Jim Thorne. He's the Chief Market Strategist at Wellington Altus. Welcome to the show.
Welcome. Thank you for having me.
So all eyes are on the Fed. This decision likely will happen around 2 p.m. tomorrow. What do you think is going to happen?
They'll do 25. They should be at 50. And actually, the Fed funds rate should be at 275 right now. President Trump is right. They're late. If it's going to take at least 2 years for the Fed cuts to get into the real economy. So they're very late, a massive policy mistake. And it's just a shame that the Fed just cannot get it right.
So why, can you speak more about why you think there should be a 50-point cut?
We should be at the natural rate or the neutral rate, which is our star, which is 275, which is at that level, the economy is in balance, and let the business cycle in the private sector work its way out. They are way too late. And so even as they cut right now, think about it, Ashley, if they cut today, we're not going to feel it until 2027 at this point in time. So they're looking at lagging data. Everybody knows the BLS data is junk. They look at lagging data and they don't take into consideration that it takes at least 2 years or more for the rate cuts to work into the real economy.
And I know you were talking about how these rate cuts could affect the markets, and the S&P target was 7,000 coming into 2025, but I know that analysts are eyeing it to get even higher, and maybe by 8,000 by the end of 2026. What do you think is driving the bullish shift?
Well, we've got a perfect environment. I think go back to 1982. We've got deregulation. So we've got supply side economics. Think Reagan economics. Think Robert Mundell, the Nobel Prize winner. And we've got demographics, and we've got two massive innovation cycles. One is AI, and the other is blockchain. So there's a lot to be bullish about. And the last thing is that there are 50% less publicly traded stocks today than there were in the 1990s. So you've got scarcity. So yeah, 7,500 by the spring and 8,000 by after the midterm elections, and we're in a secular bull market.
You mentioned AI, which is a huge area of growth right now. What do you see in the next year or so for AI?
I think it goes from the infrastructure, so it goes from the chip companies into companies that are actually applying it and creating value. So you look at a company like Palantir or Tesla, those are the types of companies that are going to embrace it and to start create value. So as this theme unfolds, it's going to get more and more pervasive within society. And as investors, what we need to do is just watch how this AI wave works through the economy and stocks so that we can invest in them.
And especially regarding the markets like the or the indexes, what's the connection between monetary policy and corporate profits in your perspective?
Well, if they cut the rates today, there's a view that the U.S. dollar is going to go down in value. And 40% of S&P earnings come from outside of the United States. 50% of earnings of the NASDAQ 100 comes out of the United States. So you get an earnings kick. So what I'm suggesting is, why the Mag 7 and why technology works and why we're going higher. It's an earnings story. And we're still not at the place where we were in the 90s. Actually, you would walk into the bar in the 1990s. That wouldn't be ESPN. It would be business television. People were quitting their jobs. Everybody was a day trader. Those folks today that say we're in a bubble have never lived a bubble. We're not even close. So we suggest invest. We suggest be on the front foot in terms of risk assets. We think the S&P 500 and the NASDAQ should go up about 5% in the fourth quarter. And we think people are really missing the fact that Bitcoin typically over the last 10 years has a 60% average return in the last quarter. So it's going to be crypto. It's going to be the shine the light on the last quarter.
Are there any under the radar storylines that you're following right now that you think we might hear about more in the future?
Well, I think it's going to be very interesting. You have Ralph Lauren ringing the bell today, and it's going to be very interesting to see what happens as interest rates come down. The U.S. consumer isn't as bad off as it was coming out of the global financial crisis. So if we get gasoline down to $2 at the pump and we get interest rates coming down, I think the U.S. consumer is going to be fine. And what we're doing right now is we're looking through what are those areas in the consumer area or the apparel area or, you know, let's say like home decoration, furniture. As we go through this cycle of rates coming down, the easy trade is to sit there and go, we're going to have a mortgage refi. As they continue to drop rates, well, where else would you go? Well, you would go into Home Depot or other companies like that. What about furniture companies? And then you'd go over and say, well, people will start going into apparel companies. So we're not going to go into a recession. We're going to go into a little growth slowdown. And for us, if we look 5 to 6 quarters out, is what does the U.S. consumer look like a year and a half out?
All right. Thank you so much. Jim Thorne, Chief Market Strategist at Wellington Altus. Thank you for joining us.
Thanks for having me.